Hello, this is Jordan, and this video is being recorded on the afternoon of Tuesday, March 7th, 2017. Thank you for joining me today. In this video, I'm going to discuss what could be the next big catalyst for gold. Now, why don't you take a moment and think about it and come up with a couple things of what could be the next catalyst for gold. Now, in my opinion, I think the next big catalyst for gold is going to be gold outperforming the stock market. So in other words, the beginning of a bear market in stocks or sustained stock market weakness, either of those things which would lead to gold outperforming the stock market when you look at that ratio, that relationship, I think that's going to be the catalyst for this fledgling bull market in precious metals to really begin in earnest. There's a long-term negative correlation between stocks and gold, and it really remains in place. And for gold to, again, begin a new bull market in earnest, we're going to need to see that that performance flip. So in other words, stock market peaks, enters a bear market or long period of sustained weakness, and then gold enters a new bull market. And we talked about this in our book, and we're going to go through history and just point out a couple examples. And so this chart is from 1973 to 1981, and we have the Barron's Gold Mining Index at the top, gold in the middle, the S&P 500 at the bottom. And the negative correlation actually, it flipped twice. So it remained in place from the end of 72 into 1978, but it flipped twice. So in other words, it started out where there was a negative correlation. It was very positive for precious metals, negative for the stock market. But then when the stock market rebounded at the end of 1974 all the way into 1976, so there for a little more than 18 months, that was the time when precious metals performed poorly and entered that bear market, that infamous one for gold, where it was down, 45% in 75 to 76. And one thing I want to point out is we're looking at really the long-term trends here. We're looking at a period of several years. So this is something I might mention later, but the negative correlation, day by day, week by week, even for a period of a couple months, it doesn't necessarily have to be in place. We're looking at the big picture here. And another thing is that gold stocks tend to be a little bit more correlated to the stock market. So you could even, in other words, if the stock market comes under heavy pressure, you could see gold hold up better than the stock market for most of that period. And just one example here is when the S&P 500 was rebounding in 75 and 76. Note in 75 that the Barron's Gold Mining Index actually held up there, and it made what looks to be a 6, 7, 8 month high there in the middle of 1975, even though gold was trending down. So, but it goes back to the larger point, which I just said, that we're looking at the long term here and not day by day or week by week. But again, back to the chart, the correlation flipped in the second half of 1976. Gold back in a new bull market. The S&P kind of went into a mild 20% decline over the next 16, 17 months or so. And then you actually had the two markets trending in the same direction. But when you're looking at 1978, 1979, the trend was much stronger for gold than for the S&P 500. So there is one analyst, Martin Armstrong, who's very infamous, and some people are extremely devoted to him. There's many others who dislike him or his work. Now, he apparently has some computer, and it's predicting that gold and the stock market are going to go up together. Now, I could see that happening, but not for several years. If you're looking at this history here, and we'll get into the next slide, but it's pretty clear that this is what gold needs. It needs the stock market to enter a bear market or have a period of sustained weakness, that's what gold needs to really get back into a new bull market and sustain that move. Now, after a year or two after that happens, it's possible they could trend in the same direction, but that's not going to happen when we see the changeover here in the negative correlation. Now here, this is the period 1996 to 2001 we highlight. I mean, we gold investors know this period very well. One of the worst, really the worst bear market ever in gold stocks, tied with the one we just had. And very rough bear market for gold. It was already at extremely low price in the low 400s, but then down below 300. I mean, that was a very rough period for precious metals, as we know. But the negative correlation was well in place here. I mean, look at the gold stocks trending down for, a period of about 5 years, maybe a little less. And same for gold, whereas the S&P 500, we all know what happened to the stock market in the mid to late 90s. But as you can see, the S&P 500 in the second half of the year 2000, it made a double top, and then just a couple months after that, we saw gold stocks bottom, and then gold bottomed a little bit after the gold stocks, and they trended higher very strongly in the early 2000s. And even after that happened, once the bear market was over in U.S. stocks and tech stocks, even when they rallied, we still saw gold and gold stocks do very well. I mean, even if you bought, remember, the bear market in stocks ended at the end of 2002. So even if you bought gold and gold stocks at the end of 2002 or early 2003, you still did very well in the years after that. So the negative correlation, it can stop at some point, and I do think that would happen, as I previously discussed. What I mean is that the negative correlation is in place for a couple years, and then after the bear market in the S&P 500 or the decline or crash, whatever you want to call it, the market would rally and then gold would continue to rally. I can see that happening at some point over the next several years. But again, I don't see that happening right away. Now, here's where we are right now. We have GDX there at the top instead of the Barron's Gold Mining Index. And as we know, the summer of 2011, gold peaked. Gold stocks really peaked at the end of 2010. I mean, they kind of made a marginal new high in summer 2011. And the negative correlation really remains in place. And specifically with gold, because we can see gold has kind of rolled over again. And, I'm not going to right now predict what's going to happen with gold, but, it's possible it could roll over and go below 1,100 and make some monster double bottom this year and then have a big move after that. I don't know. It's possible the next low could be at 1120 again. I don't know, but it's clear that the negative correlation remains in place here. The stock market went to a new high. Gold stocks, at the 2016 low, they were the cheapest they've ever been. I've talked about that numerous times. So, but as we can see now, they've kind of rolled over a little bit, and who knows with GDX? Maybe it bottoms at the December low. Maybe its next bottom is a little bit below that. Technically, maybe the negative correlation, if you look at the gold stocks, maybe it's not really in place, but we're just splitting hairs here. But back to the negative correlation, one thing I want to point out is look at what the period I've highlighted in red, where just after the S&P 500 peaked. Summer of 2015, the S&P declined, then it had a little rally in 2016, after the February low. But if you look at those red lines, from the start there to the end, the S&P 500 was down a little bit, but at that point in time, we can see gold went from about 1080 up to above 1300. Gold stocks went, they had a huge move in that period. So, again, the negative correlation, we're talking about a period of at least a couple years, not day by day, week by week, but we can see here that when the S&P 500 did correct, and it looked like it was starting a bear market there at the end of 2015 and early 2016, that was a catalyst for gold. Look what happened after that. I mean, gold had a huge move. The miners had a massive move. Now, obviously, that kind of failed. It reversed itself. Miners have been correcting. The stock market has been shooting higher. But, I mean, that shows, that was kind of a false alarm there. But that shows what's possible. And that is also reflected here in this chart where we're looking at gold against the NYSE, which is the broad U.S. stock market. In the middle, gold against the world, but that excludes the U.S., and gold against emerging markets. And we can see that all these charts are very weak. Gold against the world, gold against emerging markets. I mean, they're still well above their 2015 bottoms, but they're below the 400-day moving average. So they look pretty weak. They could go lower. But let's focus on the top, gold against the NYSE, because we can see that ratio made somewhat of a double bottom there in summer 2015, and then in November, very end of November 2015, and gold made its price low in December, and as you can see, that ratio surged over the next month or two, well above the 400-day moving average, and it held above the 400-day moving average for most of the year. 8, 9, or even 10 months there. So, and that happened to be a leading indicator because that ratio really exploded above the average at the very beginning of January. So that kind of led the huge move in the miners. So going forward, we're going to be keying on the gold against the stock market ratio because of everything we've said in this video. We just, given where we are, look, our thoughts, facts change. We can change our mind. But what we're thinking right now is that for gold to really make that next move higher, for this correction to end, we're going to need to see the stock market weaken either considerably, either it has some kind of 1987 type crash, or it has a sharp bear market over the next year and it just starts correcting, or maybe it just goes down to sideways for the next year or so. Any of those scenarios would be the catalyst that would put precious metals in position to really begin this bull market in earnest and then break above last summer's highs and have that massive move higher that we're really looking for next year and not this year. With all that being said, thank you so much for tuning into this video. I hope you enjoyed it. You can follow all of my work at thedailygold.com. You can opt in there for my free newsletter, my free weekly update, which you get every Sunday morning. It includes my most recent thoughts on the sector and some snippets from my premium update the day before. Thank you again so much for listening and watching to this video. I look forward to publishing another video update for you in the next week or two. Thanks.